We saw a lot of stocks suffer in the last 12 months under his tenure. Maybe just like is it kind of dampened a lot of investor confidence in the industry as a whole. A lot of pharma has been underperforming. Now that was Medpace up until about July 2025 when it released its Q2 report, which sent the stock soaring 50% in one day. Emmet, how are we getting on?
How are you doing this week, Mike? Where are you today?
I'm in Biarritz still, but I'm in a new background. If anyone keeps track of that kind of thing, moving apartments, so we're in between for a week.
Yeah, nice digital
There'll be
nomad.
another new background soon.
Yeah,
as
it's
well.
nice. Nice. Try and get the name of that color for me. I love keeping a log of the colors behind you.
Could be a nice marl, maybe.
Elephant
I'm
breath,
kind of
isn't that one?
elephant breath.
That is actually a color. I've heard that discussed here in my home by my wife. It's a color called elephant breath. So there you have it.
There you go. Someone made money making that.
Yeah, they did.
I'm kind of nervous about recording this episode. We're recording it early because I'm off away on holidays when it actually comes out. But the last two times we recorded, we talked about Elon Musk, and then I think the day after, they announce the $1 trillion pay package? And then we talked about Nebius last week, and then the day after they went and raised 4 billion quid or something like that. So I think we got a bit of a commentator's curse of the second we talk about something, in the meantime, between talking and recording, something happens. And that was a 2-week gap. So I imagine both of our companies are going to get acquired or, I don't know, go bankrupt or whatever happens. And we'll do all this for now.
I know. It is. You're right. It's the curse of trying to discuss something that's current, but also has a long runway ahead of it, because you just don't know what's going to happen between the moment you speak and the next hour. It's just the nature of what we're doing. If we were talking about the history of businesses only and the history of the stock market, then it's evergreen content. But unfortunately, the content we have is deciduous. Like if you listened to an episode of Stock Club from a year ago, it probably has 10% of the value we hope today's episode has.
Yeah. I mean, like, it depends. It depends on the style of episode as well. Obviously, I think something like today is going to be... So sorry, we should probably talk about what we're going to talk about.
Oh, yeah.
Basically, we picked our two favorite healthcare stocks. Is that a fair statement?
Well, it is a fair statement, but that's the way it landed. As you know, yesterday, so this will date the podcast, I put a tweet poll out there, and I asked people to pick one of the following 4 businesses for me to discuss in detail on this week's Stock Club. And I deliberately picked 4 businesses that I had already pitched for Horizon. So, but I have not yet bought their shares. I may buy their shares. And the 4 companies that I put out to poll were Lumine, as I pronounce it. I think it's pronounced Lumen, Oscar Health, Medpace, and Soundhound. So 2 of those are in the medical space. Lumine and Soundhound clearly are not. But as it happens, the winner, the one that got most votes, was Oscar, which I'm going to talk about. And the other one that got a lot of the votes was Medpace, which I believe you're going to talk about. So just coincidentally, we're going to be talking about 2 medical companies.
Okay. Before we get into those 2, do you want to give a little pitch? Because this is Horizon based. These are the 4. 2 of these stocks are on your Horizon watch list.
Well,
so
absolutely.
I think it would be appropriate to talk a bit about Horizon before we get into
Well, that's true. I mean, I think a lot of people who've listened to this podcast since it started 350 episodes ago know the story. My genesis of my investing was that in 1999, I got really excited when I noticed that Dell shares had increased 1,600 fold in the previous decade. I just couldn't believe that. Had you put $2,000 into Dell shares on the 1st of January 1990 and held until the last week of 1999, that $2,000 would have turned into $3.2 million. So I really did commit the majority of my professional life and thinking life to finding the next Dell. And I've had some great winners. And Chris Mayer, the author of 100 Baggers and Where to Find Them, said that he doesn't know anyone who owns more 100 baggers than me. He wrote the book on how to find them. So I've been very lucky. My current shareholding in Tesla is up 200-fold, or one of my positions. As everyone who's listened to this podcast knows, I have a position in Netflix that's up 650-fold, and another one that's up 400-fold, and a Chipotle that's up about 70, 80-fold. Shopify is up by 25-fold. So I have spent my life chasing businesses that warp, augment your personal wealth. And the way I'm doing that, as our listeners also know, is through a product that we have built called Horizon. And we are going to change the way Horizon is delivered to the market. Specifically, it's going to be a very much a boutique service. It's not changing massively, but what we are planning to do is, being very blunt, we're going to reprice it to $2,000 in 2026, but we're running a promo for 100 people to get it for $499 now. So if you want to get in on Horizon for basically $500 before it goes to 2,000, jump on the My Wall Street website, sign up now, or email us at pod@mywallstreet.com. So what is it? Why would you bother doing that? Well, I'm pretty sure I have found a future 40, 50 bagger in Horizon. I'll never be so bold as to say, and I think it's that one, because I will curse it. But I think anyone who's looked at the pattern of my buys will see I've bought over and over and over and over into a couple of businesses, and I have other ones as well. And right now, today in Horizon, I have a portfolio of about 25 stocks, and 6 or 7 of them are up over 100%. They're two baggers. Actually, I think ironically, let me just click on it. Netflix is the biggest winner. It's up 440% as we
Yeah,
record. But
and I don't think that's a coincidence. I think it was such a timely buy Netflix. It basically it's nadir. Kind of after 2022, was it? Right when kind of peak, I suppose, peak lack of sentiment.
yeah,
But
that's
because
right.
you know the stock so well, it was so easy to make that buy. Whereas someone else who isn't that intimate with one business as you are, you've owned it for 20 plus years,
Mm,
you've seen the ups and downs. You can recognize the temporary blip compared to
yeah.
the noise that's happening around it.
You're absolutely right. I mean, 2 points on that. You're right. I have owned Netflix shares for about 23 years, and I have tuned in, listened to, or just got the summary notes of every single quarterly call. So nearly 100 quarters of information I've absorbed, and I really feel I comprehensively understand that business, not where it is today, but its history. So it was kind of lucky that I saw that dip, and that dip happened, and we bought at the absolute low point. But the other point I want to make is there's no way I think Netflix is going to be the share today that augments people's wealth. No, not even nearly. So happens to be top of the leaderboard for the reasons we just discussed. But the attributes of a business that's going to grow 5-fold, 10-fold, 20-fold, 50-fold, 100-fold, 1,000-fold are entirely different to the attributes of Netflix today. Because Netflix now is a giant business. It's a $500 billion business. It is not going to grow 50-fold. It is going, that would basically change the laws of thermodynamics. So, but I do believe I think there's about 5 companies in there that I think at least will grow 50-fold. But it's a game of patience. And if you subscribe to Horizon, for those who already are in there, they know I care deeply. This is a community. This is something I think about day in and day out. And like summoning a genie, if you just go to the discussion board and write Emmet, I will always respond. There isn't a single message I've not responded to within an hour. So it's kind of what I do. So my point is that we are moving My Wall Street forward. We're evolving the business. I've spoken in previous podcasts about profit, and it's a magnificent service. But Horizon is going to be a boutique service for a limited number of people. We have 100 spots aside for a $499 subscription, which I know is a lot of money, but it's not if I achieve what I meant to do. Well, that's it. That's the pitch. So please do subscribe to Horizon. Go to mywallstreet.com or email us at pod@mywallstreet.com.
Okay, great. So you mentioned kind of Netflix and the scale of it. Obviously, a 50x return on Netflix from here is impossible. But I think the company you're talking about today, in your eyes, might have the characteristics of a potential 50 bagger in terms
Yeah.
of its potential and its scale and where it is now compared to where it could be.
And in fact, I'm a big fan of the four companies I put to the Twitter poll for discussion today: Lumine, Oscar, Medpace, and Soundhound. And I was confident that no matter which one won, I was able to hop on a mic and have this chat. Might have put it up to you to actually dive into. Oh, you're the one who said I'll do Medpace, so I'm looking forward to that story as well. But anyway, Oscars is a company that's under hot discussion at the moment in the Twitterverse, the Xverse. And it is definitely one of the most closely watched disruptors in the American healthcare system over the last 5 and 10 years. But I think the amount of intensity and scrutiny and attention and conversation it's now extracting from the investing world is growing. So its brand awareness from an investor perspective is growing, which is one of the catalysts for growth. If awareness grows and retail investors get attracted to it, it ultimately drives the share price up. Not that that's an important driver for growth, but it is a factual driver for growth. But let me just rewind and tell: the business was founded in 2012, and as you suppose you'd expect for any newish disruptor, it has positioned itself at the intersection of technology and insurance, which might sound familiar to those who know what I've invested in the past with Lemonade, the insurance disruptor. So Oscar feels like a cousin of Lemonade when I read through all the reports and watch the quarterly shareholder presentations. And what they're doing is they're aiming to simplify and personalize the healthcare experience. So as of now, let's say mid 2025, it's serving about 2 million members across 18 states in the United States, and it continues to expand its presence in the Affordable Care Act marketplace, while also offering a white label technology solution through its platform, which I think they've called Plus Oscar. Now, like when we chatted about Lululemon and Chip Wilson, every company starts with a founder story. So I always like to kind of start with that individual who had the spark and who saw the opportunity or happened across a fast growing opportunity. And Oscar is no different. And it was co founded by three men: Mario Schlosser, Kevin Nazimi, and Joshua Kushner in New York in 2012. And Kushner's name probably rings a bell for most listeners because he's known for founding a VC, a venture capital firm called Thrive Capital, but he's unquestionably, I think, better known for being the younger brother of Jared Kushner, who is, according to his LinkedIn profile, a senior advisor to President Trump and is also married to his daughter Ivanka. So he basically, his brother's father-in-law is the president of America. So I think that's a bigger casual flex than I founded a VC firm. But either way, they're the three
Yeah,
people.
I think the initials Jay Kushner are gonna ring true with a couple of people when they see that written down somewhere.
Yeah, so true. There's no doubt. Like, I mean, it is a name for, certainly in Ireland, it's a very unusual name, Kushner. I don't know in America, but certainly you'd have to question, and sure enough, the question would be right. He is through marriage, through brother, related to the president, which can't hurt, you gotta imagine. So he brought the VC look at my family credibility. Although, in fairness, he founded Oscar before his, yeah, but still, you know, his brother was married to the Trump family. But either way, he brought this VC credibility and he brought an entrepreneurial network, and a powerful one, you'd have to guess. But either way, Oscar quickly gained attention for being the first health insurer that was built on a full stack technology platform, which I think is just tech speak for every part of the process is underpinned by a piece of technology. So we've all worked in businesses where there's little bits that are manual. If you worked in an office in the 90s, it was, I'll walk this piece of paper over to that desk and put it there. Well, if you think of the modern equivalent, that doesn't exist anymore. So it's a full stack tech platform. And they really went for this user-friendly design and digital first healthcare management system. And I think we all appreciate good design these days. We just want our things to do what they need to do. and don't make me think. And I've often cited Uber as a good example, because you open the Uber app and effectively there's a lot of stuff in there, but there's only one big fat button, which is call a cab. Well, if you take that logic and push it forward through every product out there, that's what you're trying to go for. So over its first decade, from 2012 to say 2022, Oscar grew by focusing on the ACA, the Affordable Care Act marketplace, which for our non-US listeners, just to talk about ACA for a minute, it's a US healthcare law designed to expand access to affordable health insurance. It's designed to protect patients with pre-existing conditions, and it's there to reduce overall healthcare costs, which I think from the outside looking in as a non-American, I have a feeling that it's all very complicated and a bit of an expensive mess. That would be,
Yeah. Well, it's Obamacare.
yeah, you're right. I mean, it's a very it's Obamacare for sure. Yeah, that's how it's known on the street. But the truth of the matter is that healthcare in America for a non-American is a very complicated thing. I speak to my uncle who lives in Arizona. He's talking about Blue Cross, Blue Shield, and the one you pay for is Medicaid, Medicare. Like it's all a bit of there's a lot of jingo, and I guess you have to live it to know it. And I'm sure once you live it, you get it. So by 2021, 2022, Oscar was serving about 500,000 members, and it became publicly listed on the New York Stock Exchange. Now, despite early losses and a whole load of skepticism about the viability of a tech-driven insurer, specifically in this space, it really made steady progress in reducing its operating costs, improving its medical loss ratio, or MLR, which is just the medical loss ratio is the share of an insurance premium, insurer's premium that's spent on their healthcare. So, for example, if you pay your insurer $1, if they spend 86 cent on your care, 14 cent is what they get to run the business with. So in 2023, 2 years ago, a guy called Mark Bertoloni, who is the former CEO of Aetna, he had huge experience in this space, and he became their new CEO. And he brought a new sense of direction and his lived experience to the business. And basically, Oscar outlined a path to profitability by 2024 and set long-term goals of 20% revenue compounded annual growth and 5% operating margins by 2027, which is only 2 years away, less, 1.5 years away. So let me try to explain the US healthcare system in a little tiny bit more detail, because I always have to restudy it, as it were, before I open my mouth. And it is, in essence, a patchwork of private.
Yeah, I was gonna say, good luck.
Yes, I know. I mean, it's funny because every time I get a hold, I read a book about 8 years ago, I'd say, called, I think it was called Healing America, and it spoke about all the different layers and players in a healthcare situation and in the entire system of America. And it is inordinately complex. It is such a multi-layered, multifaceted, expensive thing to deliver an end product to a customer, to a patient. You just can't believe it even functions, but it does, and it functions well. I mean, if you're on the right side of the line. But so here's how I kind of go about explaining it. It is a patchwork of private and public payers, with employer sponsored insurance covering nearly half of Americans, and public programs like Medicare and Medicaid covering about 1/3. So you have half of people who have an employer program. That's great. 1/3 have Medicare or Medicaid, and then the remainder are buying insurance individually, or they're remaining uninsured, which is danger zone. So here in Ireland, like just for our American listeners, a small country with a small population by comparison, you either have private insurance, generally with Leia Healthcare or VHI, which makes things happen faster and in nicer surrounds. But with the public service, they'll get you fixed up if you're stuck. Or at least that's the plan. So you either go with a private insurer or you just drive yourself to hospital and they'll look after you, do their best. And obviously not everything is perfect, but that's the way it works in Ireland. So you can see why when you come from here, when we look at America, it's all very complicated. So Obamacare, as you say, or ACA, the Affordable Care Act, signed into law in 2010, and it reshaped the individual insurance market by creating marketplaces, which are also commonly known as exchanges, where individuals can purchase subsidized coverage. Are you with me so far, Mike?
I mean, like, yes, but also no.
Yeah, I know. You just got to roll with it. So these exchanges opened up opportunities for new insurers like Oscar to serve individuals and freelancers and gig economy workers outside those traditional employer-based systems. So if you and I were in America as colleagues, and my Wall Street HQ was on Wall Street, and you were living in Dakota, and we as a small business said, look, we don't even understand the healthcare system up there, you could go to Oscar as a effectively gig economy worker. I know you're not a gig economy, but you could go and you could find your own health provider on an exchange, on a platform. And this ACA market has become really important for a couple of reasons. The first is Medicaid redeterminations, which are pushing millions into the ACA plans. Now, I'm not even going to try to explain that one, Mike. But the Medicaid have redetermined a whole bunch of customers, millions of people being pushed into ACA. Then the gig economy is continuing to expand the world over. So it's especially in America, and that's creating demand for individual coverage. I was going to say bespoke coverage, but individual workers who just want to be covered. And the third kind of catalyst is that individual coverage health reimbursement arrangements, or ICHRAs, are allowing employers to fund employees' individual insurance, expanding the ACA's reach to millions more potential lives. I told you it was complex. Like there's an awful lot on the roadmap of healthcare in America. So it's not one bit complicated. It is just, it's layered. So Oscar has leaned into these tailwinds, in particular the ICHRA, the Individual Coverage Health Reimbursement Arrangements, which it views as a key growth driver over the years ahead. So, Emmet, I hear you cry, Mike. What differentiates Oscar? Um, why are we talking about it? Because I'm really worried, even as I describe this business, how it's cripplingly boring. So let me try and bring it up a notch or two. So it has three things that it's differentiating with. It has technology, as I said. It has a consumer-first design, like the big fat button in Uber. And the third is its strategic marketing, or strategic market positioning, I mean to say. So it basically has these three elements that it's obsessing on, and we could dive into those, like the full stack platform. So like, what does that actually mean? They're saying at the moment, 98% of claims are currently auto adjusted, which means they've reduced administrative costs. They have a ton of AI tools that's streamlining provider documentation. Everyone is doing AI. That's table stakes now. But what all of this, it has lots of other kind of bells and whistles on the tech, but what it actually means is that it's constantly having better outcomes. That's what matters. You go, you sign up, you sit down, you're the guy living in Delaware, you sign up for an Oscar healthcare package, and what you want is that your outcomes are better, and it's consistently posting really high net promoter scores, 66 overall in 2024, 75 for patients using Oscar's virtual primary care services, and members with chronic conditions interact with the care teams at high levels, and retention rates have gone way over 80-90%. So they have happy customers. So that's, let's say, success factor number one. Throw that in the bucket. And then it also has this kind of dual strategy, which it's an insurance and a tech platform. So it operates, as I said, both as an insurer in the ACA market, but it also has other health plans through this Plus Oscar platform. And then it has a whole bunch of personalization and inclusivity bells and whistles as well. Like, for example, they have Hola Oscar, which is a Spanish first solution for Hispanic and Latino communities, and condition-specific plans for people with multi-conditions like chronic illnesses. all of that is to say they figured out the right product at the right time. So let me just tell you about its recent performance. It reached EBITDA profitability in 2023 and total profitability in 2024. Membership has grown 40% compounded from 2021 to 2024. However, here in 2025, there's kind of some headwinds. So in July, just 2 months ago, it revised its guidance, projecting between 12 and 12.2 billion in revenue, but also an operating loss of around 200 to 300 million dollars, as a result of higher than expected ACA marketplace risk scores, etc., etc. But what I find really interesting, and let me just open this up here because it's an important, I don't want to get it wrong. Yeah. So in 2020, Oscar's revenue was 455 million. Now they're talking about an order of magnitude of 12 billion. So we're not talking about a business that has headwinds that means it's totally done for, not even nearly. So that's the kind of the past and a little bit of the present, but where are they headed? Well, they're targeting revenue growth of 20% compounded all the way through, as I said, till 2027. They plan to expand into 150 more metropolitan areas by 2027. In other words, expanding its ACA footprint. And they plan to grow this Plus Oscar tech platform to capture some of the $25 billion health plan and provider IT market, this dual prong strategy. So, as some of our listeners know, I pitched Oscar and Horizon. I've not yet bought it, but in plain speak, I love that it's one of the, I suppose, boldest attempts to reimagine and rebuild and redeliver US health insurance through technology. And I'm still a little concerned about the power and possible connivingness and maneuvers from legacy players. That would be a little bit of a concern. But right now, the business has actually, by even that metric we discuss now and again, enterprise value divided by EBITDA, it's down, down, down. The business by its own internal metric is looking cheaper than ever before, and I think it's a great long-term investment.
Yeah, I was just peeking at the numbers as well while you were talking, and like members have doubled in the space of 2 years. Obviously, you're saying revenue is up about 20-fold in the space of 5 years.
Yeah.
I just feel like there's so many implications, like even with the political climate in the US right now, the term Obamacare seems like it has a target on its back. Do you know what I
Yeah.
mean? So for
Yeah.
a company serving this market, I imagine the political implications, even though there is the connection to the president there with the brothers, brother,
I agree with what you're
brother's
saying, though.
father-in-law.
Yeah.
So yeah, I think in terms of especially this kind of market, I would be a bit concerned, but you can't argue with the scale that has happened so fast in such a
Mm,
short space of time.
yeah.
But then again, with insurance, scale means a lot less than, say, a tech company. Do you know what I mean? You can scale up to 10 million users, but if your loss ratios are useless, so it's a much more intricate kind of equation than just, say, adding users on a social media platform or whatever else, or the kind of scale we're used to seeing. So it is confusing, and I think like the complexities and intricacies you've outlined for me would be a bit prohibitive in the sense of, I don't understand this industry. It's so complex. Like the healthcare insurance, it's so politically motivated as well.
Mm, yeah.
That there's so many outside factors that I wouldn't be able to foresee that would put me off it. But I agree in the sense of, like, revenue is up 20-fold in 5 years and stock is cut in half in that time, which is just that's crazy. Like, and
Hmm.
like the scale that's happening right now, the new member additions and all the rest, and then you're obviously saying the customer love there as well. So there's a lot to like. But personally, I'd put it on the no fly list just because it's too difficult. I think we were talking with Peter a couple of weeks ago, and he has the three. He has like interested, not interested, and too hard, as his kind of stock categories when you go through screeners and stuff. And like, I think I would push Oscar in the too hard category for me, just for those reasons,
Yeah.
because
I
it
think
is
that's
it
a
is
great.
easy to get entranced with the numbers and how fast it is moving.
Totally, and that's what's held me back from buying with Horizon. It's the I don't know what I don't know, and it is. I will probably never interact with its products. Not that that matters a whole lot, because as I've often said, anecdote doesn't make data. But I do like to see if something is consumer facing. I'd love to interact with it so you can feel its magic. But you're right. I would regard it as interested but too complex for now.
Yeah, yeah. Okay, I'm going to jump into Medpace. This is a business I've admired for a while. It's actually, if there's any Nexus users listening, it was on Nexus 2. And for a lot of reasons, so as in obviously if it's a Nexus 2 stock, it's going to have certain characteristics. It's going to have things we like, things that, we were talking about Chris Mayer early in the episode. We've kind of tried to quantify and turn those characteristics into some form of filter for stocks all across the world, and then they spit out incredibly high quality businesses, and Medpace was one. And I'm gonna just say, if you're listening and you can hear that droning in the background, excuse it. It feels like it's inside my brain, and if not, Emery's done a great job of editing it out in post. But to give more insight, Medpace it's what's called a contract research organization. So essentially, what it does, it companies can outsource their clinical trial process. So new pharmaceutical or biotech companies, it manages the phases of clinical trials for drug or even medical device companies as well, but mostly drug companies. So services are designed to help these companies kind of navigate a really complex area of bringing a new drug to market. So it's essentially a pick and shovel play for the entire biotech sector. Um, this might come as a shock to Emmet, but bringing a new pharma product to market is quite difficult. So on average, it's estimated that going from, say, drug discovery to FDA approval costs around $1.3 billion and can take up to 15 years. And then almost half of that 15-year period is spent in the clinical trial phase. So when we add on the fact that new drugs typically enjoy a 20-year patent from discovery before generics come in and kind of erode the competitive advantage there, it showcases how important a process like this is when it's done fast. Literally, time is money here. Do you know what I mean? So the more patent protected years you can enjoy on the market, the more profitable the drug is going to be, and the more worth, say, that 1.3 billion you've invested into this clinical trial is going to pay off essentially. But for smaller players and startups and all the rest, they don't have the money or resources to conduct these clinical trials in house. So outsourcing to a company like Medpace is so important. They have an experienced, proven vendor. Medpace has been around for over 30 years. So it's got all the clinical and regulatory know-how there already. That's a huge benefit because that reduces the risk and like vastly improves the chance of success for these clinical trials. If you're a new company, you're Emmet Savage Pharma, and you have this new wonder drug, but you have never brought a drug or anything through clinical trials before, outsourcing that is such a no-brainer decision. Do you know what I mean?
Hmm.
And on top of that, it's also faster. We talked about time being
I
money
think I know what
in
you're
terms of
saying. I think you're suggesting we try and figure out a drug and then outsource it to Medpace.
well, if me and you did figure out a drug, that's where we'd be going, anyways. That's for sure. But there was a study done that proved that trials done through a CRO are completed up to 30% faster than in-house,
Yeah.
which is huge. Which is
Mm-hmm.
like, if you think about that in terms of dollar amount, is absolutely huge. So the investment thesis is there in a nutshell, where if you are a smaller player, you can't afford in-house CRO optionality essentially. You go to a company like this, they'll do it all for you, and they take away a lot of the risks involved. They reduce the time factor, and essentially, like, as in, pay the ROI on this is huge if you don't have the capabilities to do it yourself. So at the minute, Medpace controls about 5% of the small and medium biopharma CRO market. So that's about a $28 billion market. So there's lots of potential upward movement there. And then if it wants to really expand its TAM, which is kind of dipped its toe in so far, beyond its bread and butter with the smaller players, the total CRO market is estimated to be worth about 65 billion. Now,
Whew.
obviously, a lot of that market's not going to be attainable. There's going to be in-house players, there's going to be specialists, but it shows that there's a lot of room left to run, even though Medpace has been around since 1992. It's been around since 1992, but it's been a public company since 2016. And up until the middle of last year, it was basically one big party. The stock was up about 1,500% in that time. Uh, and in fairness, a lot of that time was a great time to be in the biotech industry. There was a lot of VC money flowing around. That dried up in about 2022. Now, Medpace's demand was delayed from that, we'll say. But so, like, sorry, Medpace party didn't start at 2022. It stopped at about 2024. So in July of 2024, it hit a previous all-time high, and then in the 12 months after that, it fell about 30%. So there's a lot of factors at play there. I think a lot of Medpace's demand comes, it trickles down from, say, VC markets. If VC markets are putting a lot of money into new biotech startups have the money to spend a lot on clinical trial services like Medpace. So it kind of comes down the way. So the funding market was hit at about 2022, and then in 2024, it kind of all came to a head a bit. So it was a very tough 12 months. And what didn't help things either is RFK's appointment as the health secretary. So
Oh yeah,
this,
why?
well, he's skeptical, shall we say, on the pharma industry as a whole. And that cast a pretty wide shadow. We saw a lot of stocks suffer in the last 12 months under his tenure. Maybe just like, it kind of dampened a lot of investor confidence in the industry as a whole. Like, you're looking at high quality business. Like, I remember Danaher is still down heavily.
Yeah.
A lot of pharma has been underperforming. And whether that's, a lack of demand or a lack of investor confidence, I think it's kind of a combo of both. But we are seeing that industry suffer. Now, that was Medpace up until about July 2025, when it released its Q2 report, which sent the stock soaring 50% in one day.
Yeah.
Yeah, so earnings and revenue blew past expectations. Its book to bill ratio, essentially, is it taking in more bookings, more future revenue contracts than the actual revenue it is posting on that day, was up above one again. So it's a great test of demand. If the book to bill ratio is above one, it means that demand is high, essentially. So it raised EPS, earnings per share guidance, from 12.26 to 13.04. It raised its earnings per share guidance from, its low point was 12.26 and its high point was 13.04 originally. That went up from a low point of 13.76 to 14.553 on the high end. Sorry, that's a bit of a word salad, but basically, absolutely blew past expectations and shot up its guidance. Growth forecasts for the second half of the year were way ahead of the first 6 months, and it was one of those kind of very much seminal earnings reports. Like, as a company of this scale, I think it's worth 20-30 billion, going up 50% in the space of one day is just kind of nuts. But it did a lot of things. So, like, we were talking about investor confidence and then perceived lack of demand, and this report kind of blew both out of the way in the space of a half an hour in July. So it really goes to show that the perception played a lot in this. And I think, in terms of biotech funding, in terms of investor confidence, in terms of, say, the administration's maybe lack of enthusiasm around the industry, it would all kind of came to a head. And then Medpace kind of showed, actually, wait, maybe that's not really playing out the way it did. So loads of good stuff coming out from that 2 months ago in July. And then on top of that as well, throughout that period, throughout that downturn, Medpace was repurchasing shares hand over fist, which is looking pretty good right now. So a lot of good things coming, and an awful lot comes from the top. So I want to talk about the CEO,
Yes.
August Trundle, founder and CEO.
Yeah.
He's 60. He's 68, but if you see him, he looks about 20 years younger. And this is such a nonsense tangent, but it made me think: is there like a requirement of healthcare CEOs to look good and young and fit and healthy? Do you know what I mean? Would you think less of Novo Nordisk or Eli Lilly if their CEO was some owl fella with big bags under his eyes and he smokes 50 a day and he has a big alcoholic's nose? Like, it's so stupid, but I actually think I would. Like, as in, I think a pharma CEO, a healthcare CEO has to be healthy.
A
Is
picture
that
of
is that
health.
a weird thing
Yeah.
to say?
No, I think it's probably one of those unspoken biases that exist. It's not shocking that the CEO of a healthcare company is a picture of good health, no more than it should be shocking that the CEO of a cosmetics company wears cosmetics, and you kind of got to exhibit what it is you're living, or live what you're exhibiting rather.
Yeah, I was thinking that when I saw like a picture, because you see the age 68 as CEO, and he owns just under 20% of the outstanding shares at the minute, which is obviously
Mm,
big, huge plus. We love seeing insider ownership. We love seeing leadership aligned with shareholders. Like, I think is it about 3% founder led businesses outperform the market by?
yeah,
Um, like, it's a proven stat. Like, as
yeah.
in, we look for it. It's a big factor in our calculations for adding a stock to Nexus. Do you know what I mean? So Medpace was always an example of that. And Trundle, he found huge success on the stock market
Mm,
because of his long term vision, and because his ownership means he isn't looking quarter to quarter. He's looking decade to decade. That's what we want as shareholders. It's why we love insider ownership so much. But at 68, this kind of brings in question marks. Like, having an iconic CEO has a shelf life. And I imagine, however healthy he looks, he'll want to
mm,
sail off into the sunset
yeah.
at some point. So there's no official succession plan in place. It
Oh,
looks
that's
like,
interesting. I didn't know that.
yeah, it looks like it'll be President Jesse Geiger. He joined Medpace in 2007. He moved from CFO to COO, and now he's president. And Medpace's strategy has always been to hire internally. It likes to hire people out of college, promote from within, and then avoid external senior hires, just to kind of instill that company culture and all the rest. And I suppose train people in the way they see the world, or they see that industry. So it does look like Geiger is kind of being propped up as potentially the replacement, but we don't know. There's no official communique on that yet. But having, it'll probably be 20 years plus under Trindle's guidance by that time that comes, which should hopefully kind of be able to continue on his legacy. But again, it would be one of the big risks I would see with Medpace, is that a key person risk. We talk about it a lot, but if you have an iconic CEO, Elon Musk is for Tesla is always a big example. And you see how much Tesla's board are doing to try to keep him there, because he's so attached to the success of the business and the stock. And I think Trundle, obviously, he doesn't have the name of Elon Musk, but he would be as well. And I think if you're talking about an investment thesis, it's so important that he's there. So being wary of his eventual transition away from the top spot will be top of mind. Other risks, I think they have a lot of customer concentration. So the top 5
Yeah.
customers account for 23% of revenue. And like, while none of them represent over 10%, it's a big reliance on a few names, especially in a competitive industry where they could be poached. I'd be very wary about that too. And then lastly, look, I mentioned it already, but just the way the funding of market is going for biotechs. Um, Maybe Medpace has booked the trend a bit there with the earnings and projections from Q2, but it's a variable that's out of the company's control, which I don't like, which adds a level of volatility to the share price. And just, it doesn't matter how well managed the business is or what they can do themselves. If there's no money coming from that kind of top funnel, it won't get to trickle down to them.
Mm,
And that's what
mm.
I would be concerned about. Now, in fairness, but they have about a 3 billion, just under $3 billion backlog. And I was telling you already, the book to bill ratio is above 1. So they're getting in more orders than actually, um, recognizing revenue in a quarter, which is huge, and like
Yeah.
shows the demand is there. But
Let that go backlog for ages. When I pitched it in March of last year, so I pitched it in Horizon about a year and a half ago. And as these things go, when you've something on your watch list that you don't own, when its price goes up, you feel it way more than a stock you own that goes up. When a stock I own goes up 20, 40, 50% or double or 100, whatever, I'm like, yeah, whatever, yeah, grand. I'll just leave it there. When a stock I was watching goes up, I'm like, no, I knew that was going to happen. When in fact I didn't actually know it was going to happen. I just felt that kind of FOMO, or I nearly did it remorse. I don't know what name we can give that. But I was watching the day after the stock jumped 50%, went up from like $300 to $450. And I was looking for a pullback, which barely happened at all, which showed
Yeah.
in some respects that the fundamental announcement that drove that 50% increase in value was real, very tangible. And what you just said was came back. I mean, they still have an order backlog. They can't sell the stuff they do fast enough, which is quite a
No,
quality position to be in.
well, absolutely. And we're talking about clinical trials could take, 10 years for a certain company. So obviously that backlog is always going to be there and it's an important thing to track. But I keep bringing up this book to bill ratio, but if they are bringing in those new orders faster than revenue is being recognized,
Mm,
that means there's always going to be that backlog there.
yeah.
And it's so important for a business like this. And it's one of the key metrics to track. Certain other industries as well is very important, like semiconductors. This book to
Mm,
bill ratio is a very important metric. But yeah, I think Medpace, it's a really, really high quality business. Always has been. Yeah, if we were very astute, well, I suppose our Nexus 2 users got in at a reasonably good time. They had a
mm,
bit of pain before they had a bit of
mm,
pain before
yeah.
July of this year, but they're up pretty handsomely now. And yeah, it's one of those businesses I've always liked. Um, but again, it's complex. There's a lot going on that's out of its control. It's not dissimilar to Oscar Health in that case, where external factors could really weigh heavily on it. But at the minute now, I think it's trading at or around all-time highs.
Hmm.
Pretty pricey stock. If you are interested, I think I'd recommend kind of building a position over the course of a year, maybe doing some dollar cost averaging every month or something, because I think it's about 37, 38 times earnings, which is fairly pricey, even in this current very pricey market. But yeah, Medpace, kind of the comeback kid of the year, I would say,
Yeah. Yeah.
especially
Well,
especially
nothing
out
beats
of
open door, but let's just hold that for another conversation.
open doors is a
Yeah.
completely different animal.
Okay, Mike, I have a question for you. If you $10,000 and just those two businesses we discussed today, MedPace and Oscar Healthcare, and you could split that 10 grand across only those two businesses, how would you invest? What
Oof.
percentage would you put into one and what percentage into the other?
That's a good question. I'd say probably 9 grand Medpace,
Mm.
1 grand Oscar Health,
Mm.
maybe. I'd
Uh,
have more confidence in Medpace. And then, like, in fairness, now that's me knowing Medpace a lot better
yeah.
than Oscar Health as well. I think from my knowledge of Oscar Health is kind of what you pitched me today and the odd seeing the ticker on Twitter and stuff. Whereas Medpace, I wrote it up for Nexus last year. I've been following it since, and yeah, I would be much more intimate with that business. So
Mm.
that's why. But yeah, what would your split be?
I hate to be unoriginal, but I'd go 50-50. When I was formulating that question, my gut was 75% MedPace, 25% Oscar, but they are both addressing a huge need and they are both being very well run. One is the rabbit strapped to a rocket, which is Oscar, and the other is this rolling steamroller, like, and that's med pace. So I'd probably go 50-50, 5 grand into each. At least then, if one works out, doesn't matter. I'm okay. I'm good.
Yeah, yeah. We don't talk about healthcare stocks a lot, for good reason. I think it's a incredibly complex business, but there's so much money in that industry as
Mm,
well. If you have any sort of insider um, edge, I suppose, if you're working pharma or if you work in biotech or whatever else, or even just in, like, say, VC,
mm,
I feel like that could be a very profitable area to be in as an investor,
mm,
because it's so complex, because there's so much tacit knowledge needed. I think even like when we're pitching two stocks like Medpace, I would know very well at this stage. Still would need a lot to figure out, say, the external factors of the funding markets and stuff like that. You know what I mean? So So yeah, there's a lot of things at play, but again, so much money in there as well. Like talking about stocks, like say, like United Healthcare is an interesting one now, where that stock is down whatever 50, 40, 50%. I know there's an awful lot of funny stuff going on that caused that drop, but I feel like someone with insider knowledge of the industry would be like, oh yeah, that's definitely temporary. Buy,
Yeah.
buy,
Well,
buy.
look, Warren Buffett
Whereas
just backed the truck up and loaded up at UNH.
there you go. Whereas I don't know if I would have the confidence, because we were talking about, the political implications and the insurer history and all the rest. Like, as in, I wouldn't have that same confidence to go and make a big bet on United Health uh,
Mm,
without that insider knowledge of the
yeah,
industry. So yeah,
I'm with you.
but no, it was a good one.
Well, before we totally put the lid on the conversation, what I do like about Medpace is that the complexity of what they do is in a laboratory, and it's all the white coats, and the work that's being done is very complex. But from an investor's perspective, irrespective of the outcome, Medpace, once they nail what they're doing in the lab, it doesn't matter if the drug is a success or a failure. Whereas if you invest in a pharma, the outcome, the efficacy of the drug in question will affect the fortunes entirely, whereas Medpace gets paid no matter what the outcome is. And I particularly liked that about the business. So when you move out of the lab and look down on the business, you could construct an argument, say it's quite a simple business. It's an outsourced model for something
I,
highly complex.
I think it's quite a simple pitch,
Yeah, yeah.
pick and shovel play for biotechs.
It is a pick and
Uh,
shovel play for biotechs. That is
yeah,
exactly what it is. So it doesn't matter what you want tested. We've got the capability, and we can tell you the outcomes.
exactly. And we'll take away all the complications
Mhm.
and costs, and well, not all the costs, but like all the things you don't know, we know.
Yeah.
So give us your money and we'll do it for you.
So that's it,
Right.
folks. Put in your drugs ideas, and what we'll do is we'll write up a white paper and we'll send it into Medpace to check for us.
Good man. On that, I think we'll call it a day. Emmet, thank you for joining me, and thank you everyone for listening. If you are listening and you haven't left us a review, if you haven't subscribed to our YouTube, our Spotify, Apple Podcasts, wherever you're listening, please do. It does help the show. And we'll talk to you next week.